Imagine making $142 a day and doing absolutely nothing. That's an extra $3,000 a month, and it's just the beginning. Hey Bowtie Nation, Joseph Hogue here, and we've done weekly dividend videos as well as covered the best monthly dividend stocks. Well, what could be better than weekly cash flow, but a dividend check every single day? I'll show you exactly how to build a dividend portfolio for daily cash flow, how to find these stocks, and how much to invest for the cash you need. Now this strategy works because dividend stocks pay on an extremely consistent schedule. Dividend-paying companies know their investors rely on that cash flow, so they try to schedule their dividends during the same weeks every 3 months. That means planning your dividend investments right. You can build a portfolio that will send you a check every single day to help pay your bills. Now, I'm going to show you that list of dividend stocks next, but understand this is going to be a monster of a list. Think about this. There are about 250 days the stock market is open each year, and most dividend stocks pay 4 times a year. That means to get a check each of those 250 days, you're going to need about 62 dividend stocks. That's 62 dividend-paying stocks sending you money 248 days a year. Unfortunately, we've also got 2 monthly dividend stocks in here that are going to pay you 12 times a year each, but be ready for a big list to keep that cash coming. Stick around later and I'll show you how I found these, how to plan out your list, and exactly how much to invest. This first group of stocks will send you a dividend check in January, April, July, and October. It's 18 stocks plus the 2 monthly dividend payers for a total of 20 checks. I'm not going to talk through every stock on the list here because we've covered most of these on the channel before. I'll highlight a few of the really exceptional stocks and leave links to other videos in the description. Since all these are in the S&P 500 index, that market index of the 500 largest companies in the United States, they're all going to be big blue chip companies with a lot of financial stability. Nothing can guarantee a dividend, but it's a pretty good start with these. Working through the list, you're going to notice I've also tried to get good diversification across sectors in each group. Here we've got everything from tech and financials to healthcare and real estate, spreading your portfolio out for less risk. Pfizer, ticker PFE, hasn't been in the news quite as much as it was during the pandemic, but is still one of the world's leading drug makers with a strong 3.3% dividend yield. Pfizer has worldwide reach with 1.4 billion patients, and it doubled its sales during the pandemic. The company is expected to post 26% sales growth this year before that falls to about 21% next year on that drop in vaccine demand. But this company is a leader in drug innovation, especially in the new mRNA technology. This new methodology could spark breakthroughs not just in vaccines, but across disease and medicines. Pfizer always has a full pipeline of new drugs and launched 13 new clinical studies last year, ensuring even as demand for that vaccine falls, new ones are going to be taking its place. More impressive, and why I continue to buy Pfizer stock, is that the company has been able to do all this while keeping its operating margin consistently above 25%. That's even against the need for spending billions in research and drug development, and has been able to do this without adding billions in debt. Pfizer's debt-to-equity ratio is just 44% versus something like a Merck, which is 77% of its capital structure in debt. Now, you can't talk dividend stocks without JP Morgan, ticker JPM, and its 3% dividend yield. JP Morgan is the leader in banking with over $4 trillion in assets, about half of that in deposit accounts. It also has the strongest capital markets business in the industry, which is why it's outperformed over the last 5 years with a return of 28% versus the broader banking ETF. Now, the bank did maintain its dividend at just $1 a share after the most recent stress test by the Fed, but increased it 11% last year and has doubled the payout over the last 5 years. According to research by Barclays, JP Morgan has the highest capacity to increase its payout, with the potential to return almost $19 billion to shareholders just this year. Estimated dividend payouts are in orange here, with stock repurchase programs in gray. JP Morgan is followed closely here by Bank of America and Wells Fargo, each with the liquidity to return more than $15 billion to investors over the next year. We've got our first group of dividend stocks, but I wanted to make sure you know how I found these and how to use this strategy to create your own daily dividends list. This all starts with the fact that most dividend stocks pay out every 3 months on an extremely consistent schedule. Dividend investors love that certainty and the consistency, so directors of these companies try to declare and pay those dividends on the same week every 3 months, some even down to the same day. So what you can do, you can put together a list of your top dividend stocks, or do like I did and research all 360 stocks in the S&P 500 that pay dividends. You then go to a site like Yahoo Finance, you can go to the stock, and here I'll click the Historical Data tab. I can change the time period to the last 5 years and then to show dividends only and click apply. The site here is going to show me the ex-dividend date of every dividend payment for the stock over the last 5 years. And you can see these are consistently the same time during the same months. For example, AT&T consistently has that dividend date towards the end of the first week in January, April, July, and October, and that's going to be paid out about a week after the ex-dividend date listed. Then it's just a matter of getting all this into a spreadsheet like I did here, noting when each stock goes ex-dividend. Once you have that list of dividend stocks, you can plan it out like I've done for this portfolio. I first went through and made sure I had all my favorite dividend stocks, the ones with the highest yields and the best growth. Then I went back through to make sure that we had at least 4 or 5 dividend stocks paying each week. You'll notice that some of these days do double up, and some weeks have more than 5 payments, but it still comes out as close as possible to a dividend payment each day the market is open. This is a great list. 58 dividend stocks, 2 of them monthly payers, and 248 dividend payments every year. Even better, the group pays an average dividend yield of 4.26%. That's nearly 3 times the average 1.5% yield on the broader stock market. Now that dividend schedule is important, but it's not the only thing. So I'm going to show you in a minute how to pick your dividend stocks so you get not just those daily cash flows, but also strong price return as well. I'll also make this full list of dividend stocks available for download, so look for that link towards the end of the video. This second group of dividend stocks will put cash in your pocket in February, May, August, and November with 18 checks a month, including our 2 monthly paying stocks. We've got a few lower dividend yields in here like Archer Daniels and SPGI, but the average yield still approaches 4% on those big payers like Newell Brands and International Paper. I'll keep the screen up a little longer so you can see each one, but again, I'm going to make this list available for free download later. Let me know in the comments below if you think another dividend stock should have made it on the list. I recently added ConocoPhillips, ticker COP, as the only energy stock in our Bowtie Index. I know a lot of dividend investors aren't impressed with the weak 1.9% dividend yield here, but don't be fooled by that lower headline dividend. That's just what the company pays out for its regular dividend payment. Like other energy stocks, right now ConocoPhillips is a cash flow machine, and it's returning that cash to shareholders. The company upped its share buyback program to $2.5 billion this year. That's about 1.7% of the outstanding shares. More importantly though, Conoco has what is called a variable return of cash. Here on the right, this is a special dividend the company pays out in months staggered with its regular dividend, so investors are actually getting payments almost every single month. On the 8 regular and variable dividend payments over the last year, Conoco has actually paid out $4.44 a share, or a yield of almost 4%. That, along with the cheaper valuation on this stock and stronger growth, make it one of the best, if not the best energy stock to buy right now. And Conoco probably has the best production profile among the major oil companies. And more than half of its planned oil production over the next decade is going to come from that Permian Basin fields in the south, and with some from the Bakken and Eagle Ford's region, but much less internationally than a lot of the other majors like Exxon. This is going to be important for 2 reasons. First, it's going to help protect the company from those geopolitical problems drilling in other countries, or a loss of fields like Exxon had to take when it exited Russian production earlier this year. It also means Conoco is going to benefit from some of the lowest cost oil production in the United States. This analysis by Raymond James shows the oil price needed to break even on production in various fields. You can see Eagle Ford production here around $40 to $45 a barrel, with Bakken fields as high as $55 a barrel. Permian fields, though, those are in the Midland and Delaware resource plays on the left, with a production cost as low as $35 a barrel. This is going to mean low-cost production for Conoco and stronger cash flows, supporting that dividend yield and price gains. S&P Global, ticker SPGI, offers the lowest dividend yield on the list at just 0.98%, but I think this one has a surprise upside potential. S&P combined with HIS Market last year to merge its data and benchmark tools with the leader in supply chain intelligence. And it turns out it was a smart move, as that bottleneck in supply chains over the last couple of years really put a premium on market intelligence and data. Combined, the new company is going to get about 1/3 of its revenue from that market intelligence segment and 1/3 from its rating agency on bonds, along with 4 smaller segments. Now, revenue growth has been a little slower than peers over the last few years, but I like what this merger is going to do for the business, and besides that boost to revenue, I think it comes through in stronger profitability as well. The Southern Company, ticker ESSO, is one of the highest paying utility operators on the list, with a 4.1% dividend yield. The company operates as a regulated electric utility, serving more than 4 million customers in Georgia, Alabama, and Mississippi, along with 4.4 million customers in natural gas. And Southern has been one of the most aggressive in the utilities industry for its push to clean energy. In 2000, nearly 80% of the company's electric generation came from coal. Today, that's just over 20%, and the company is pushing further into nuclear, natural gas, and renewables than anyone else. Now, while it has meant higher costs to ramp up that footprint, the early moves into renewables could pay off for the company and investors through higher cash flow over the rest of this decade. We're halfway through our list of dividend stocks, but I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. This third group of dividend stocks will send you a check in March, June, September, and December. It's the highest yield of the three, with an average 4.8% dividend on some big pairs like Devon Energy and Altria Group. Now you'll notice I do have Philip Morris and Altria on the list, but don't feel like you have to include them in your list. Use the process I showed you earlier if you want to find another dividend stock that pays around the same weeks to switch out for these or really any stocks in the list. Devon Energy, ticker DVN, has long been a favorite of mine, and I recently highlighted as the company as one of the 5 dividend stocks better than the QYLD. Now, hold up. Now I know there are a lot of QYLD believers out there, so I'm going to leave a link to that video in the description. Make sure you click through to see what I mean. Devon is a leading oil producer in 3 states, North Dakota, Texas, and Delaware. With oil spiking over the last 2 years, these assets have become like cash flow machines, and like most companies, Devon is choosing to return that cash to shareholders rather than acquiring more assets at higher prices. Free cash flow quadrupled since its merger with WPX last year, and it's forecasting even stronger cash flow this year. The company is break even at a price of just $30 a barrel, well under the 80 plus oil has been at lately and is likely to stay most of this year. At $85 per barrel oil, the company will grow free cash flow by 14% this year, and prices could fall 65% to that $30 a barrel before the company is operating at a loss. This all helped Devon increase its share buyback program to $1.6 billion, nearly triple what it bought back last year, and continue that history of dividend growth. Iron Mountain, ticker IRM, hasn't grown its dividend quite as much, but pays a strong 4.7% yield and leads in this industry of records management. Iron Mountain is the leader in that physical record storage with nearly 1,500 facilities in 63 countries. It's a slow growth market that keeps out the competition, allowing IRM to dominate that market and then push its free cash flow into expanding its data center and digital storage business. Storage and records management is about 2/3 of the revenue, that pie on the left here, with data center a growing part of the total. IRM also has a strong service segment with higher margins to help boost its bottom line. Again, this is just a slow growth business, even with that data center component, but the cash flow is more than enough to sustain that dividend plus some price appreciation. Management has held the dividend steady throughout the pandemic, so I would expect an increase sometime this year or next, which could help boost that share price. BlackRock, ticker BLK, the largest asset manager in the world with $8 trillion in assets, also made it onto our Bowtie Index. In fact, if this was a country, only China and the United States would have a larger economy. BlackRock is the company behind the iShares exchange-traded funds, along with its index funds that power its passive investment strategy for every theme and goal imaginable. It's a very stable source of cash flow to complement that trillions of dollars in credit market and forex assets it manages. While growth in China has slowed over the last couple of years, it could become one of BlackRock's core strengths in the years to come. The company was granted permission to be one of the first asset managers to provide mutual fund business in the country, and its biggest competition, Vanguard, largely gave up on the market in 2020. Shares only pay about a 2.7% dividend here, lower than the group average, but the company has grown its payout by 10% a year over the last 3 and total return of 16% a year. We're coming up on the 2 monthly dividend stocks that are going to pay you 12 times a year and exactly how much to invest to make that daily cash flow. But if you want a smaller list, I'm going to link to our weekly dividend portfolio in the description below. In it, I'll show you how just 12 dividend stocks can give you weekly cash flow, so check that out. I also want to give you some criteria for picking these stocks. With more than 350 dividend stocks in the S&P 500 alone, you're going to have plenty to choose from to create your cash flow. So you can be picky here, only buying the very best dividend stocks for that yield and return. And a big part of that is actually recognizing it's not all about the dividend yield. If 42% of the total return on stocks is from dividends, that means another 58% has been from that price appreciation, from the price returns. Just chasing the highest dividend yields and ignoring returns means that you're going to be missing out on a big part of investing. Now, another way is you can get all technical here and calculate your returns, or you can go easy and just check out the price chart to make sure that the stock is producing positive returns. For example, shares of Devon Energy. Not only do you get that 8% dividend yield, but the stock has doubled in the last 5 years. We talk a lot about fundamental analysis here on the channel, like price to earnings ratios, other valuation measures, as well as just comparing stocks by their operating margin. Now, I want to get back to our list, so I'm just going to link to a few videos on that stock analysis below. One last thing I will say about creating this list of dividend stocks is make sure you diversify your companies by sector as well. And this means making sure you have stocks from at least a few of the 11 stock sectors. Those broad groups of stocks and topics like technology, utility companies, and materials. Making sure you have companies from at least 5 or 6 of these sectors means you're going to protect your portfolio and your cash flow from any single event that destroys a particular group. We get 24 dividend payments from just 2 stocks on the list, our 2 monthly payers. That's Realty Income, ticker O, with a 4.6% dividend yield, and SL Green Realty, ticker SLG, with a solid 9.3% dividend. Realty Income, ticker O, is one of the most popular dividend stocks around for its 4.6% dividend paid on a monthly basis. Realty Income is the only REIT in the Dividend Aristocrats list with annual dividend increases since 1994. In fact, that 4.4% annualized increase on the dividends over nearly 30 years and a double-digit shareholder return. The company owns over 11,000 properties in the retail space, so it's going to see weakness on any drop in consumer spending or a recession, but these are diversified across every industry, from retail to grocery to convenience, dollar stores, and restaurants. So not only do you have some good diversification here, but many of these are in industries with a little bit more stable cash flows than your cyclical retailers like apparel and electronics. An interesting development lately for Realty Income is it started expanding internationally with 225 properties in the UK and Spain. Now, we are seeing quite a bit higher inflation in Europe, so consumer spending is probably going to fall there, but that portfolio represents less than 2% of the company's total property, so not something that's going to hurt in the short term, and I like the idea for that international growth for the future. The company operates on a triple net lease strategy, so the tenants are going to pay all the property costs, which makes for lower operating costs for the REITs, for Realty Income, and the average lease length is at 9 years, so that long-term leases to keep that cash flow stable. Realty Income has been able to maintain a 98% occupancy rate, more than 4% above the REIT average, really speaking for its careful process in leasing. I'll put the download link to the entire dividend list in the description below. But now, how much to invest for $100, $150, or even $200 a day in dividends? To find how much you need to invest, you only need 2 numbers: the dividend yield on your stocks and how much money you want to collect. Remember though, dividend yields are always shown on an annual basis though. For example, when you see Devon Energy pays an 8% dividend yield, that's an 8% annual return on the shares paid out in dividends every 3 months. That's March, June, September, and December for this stock. So for example, let's say you need $1,000 in dividends a month from your shares of Devon Energy. To make this a yearly number, you just multiply by 12 months for that $12,000 a year from your shares. Then it's as easy as dividing that annual amount, the $12,000, by the dividend yield of 8% to find how much you need to invest. So to receive that $3,000 every 3 months when Devon pays its dividend, or $1,000 a month income, you'd need to invest $150,000 in the stock. We can use this to find how much we need to invest in each of our dividend stocks to get that daily cash flow. Let's say $150 a day. There are approximately 250 trading days in the year, days when the stock market is open and dividend stocks can schedule their payouts. To find the annual amount then that we want to earn, we just take that $150 a day times 250 days for $37,500 in annual income. Now, altogether, we know our dividend stocks average 4.26% dividend yield. So instead of finding how much we need to invest in each individual stock, we're just going to find the average here. If we need $37,500 a year divided by the annual dividend yield of 4.26%, that means we need to invest $880,000 in our list of dividend stocks. And if we spread that across each of these 58 stocks, we'd be investing just over $15,000 in each dividend stock for that $150 daily cash flow. You're damn right it's a lot of money. And yeah, it's going to take a while to get to that point, but that doesn't mean you can't get started right now. Invest as little as $100 a month. Reinvest your dividends, and I guarantee you, you will get to that point. The point where you can live off your daily dividend check. Click on the video to the right for that simple 12 stock portfolio for dividends every single week. Just 12 dividend stocks to buy for that constant cash flow. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.